Hi, everyone. Thanks so much for joining us. We'll get started here in just a minute. I want to give everybody a chance to join. Okay, well, we're going to go ahead and get started. Good afternoon. My name is Cindy Nellis, and I'm the director here at the Penn West Clarion Small Business Development Center. And we welcome you to today's webinar on LLC operating agreements. Limited liability companies have become a popular type of entity in recent years as they offer flexibility for many businesses. And when forming an LLC, it's recommended that the company have an operating agreement to detail the rights of the members and govern the internal operations of the business. The presentation today will focus on the importance of an operating agreement and key provisions that should be included. I want to get started just with a quick introduction about the Small Business Development Center. We'll go into some specifics of how we'll operate today, and then we'll get started with our speaker. So the Small Business Development Center, we are an organization that is here with a mission to help businesses start, grow, and prosper. We provide one-on-one business consulting services primarily. We also do a lot of training seminars like today. And then we also give you the opportunity to connect with us for specific tools and resources as it relates to helping your businesses start and grow. So we're truly an organization here to help you make better business decisions. Our one-on-one business consulting services are provided at no cost, and it's confidential. Our training seminars are either at no cost, like today, or a low cost. We also purchase databases to help in doing industry and market research. And so connecting with us to get access to that is great. We also have a lot of forms and templates and guides that we'd like to share with you as well as we work with you one-on-one. Our statewide website is pasbdc.org, and we encourage you to check that website as there are many types of additional training seminars that are being offered every single day. This is a map of our network. We're made of 15 centers, all located at institutions of higher education, sprinkled throughout Pennsylvania. As you can see, take a look at your county and the SBDC that covers your county. Just to let you know, the way that we are able to offer our services at no cost is because we are supported by our host institutions. But primarily our funding comes from the federal government through the Small Business Administration and through the state government through the Partnership for Regional Economic Performance. The WEDNET program is another program that we wanted to quickly highlight today. It stands for Workforce and Economic Development Network. This program provides funding to companies to help keep their employees up to date on their skills and keep their companies competitive. We are a WEDNET partner, as well as Kutztown University SBDC and many other WEDNET partners, again, located throughout Pennsylvania. To get this funding, your company needs to qualify, your employee needs to qualify, and the training itself needs to qualify. And if that is the case, then there could be funding for you of up to $2,000 per employee. We encourage you to check out that program, wednetpa.com, and submit an inquiry to get started in looking at that particular program for your company. And this is my contact information. A couple logistics before we get started. The recording today will be provided along with the slides that you see. As far as questions today, we'd like to hold the questions till the end, but we do encourage that you submit them in the Q&A. If you have a question for me, your host, I ask that you submit them in the chat box. So with that, I'd like to introduce you to our speaker, Stephanie Woos, I believe, currently serves as a staff accountant for the Penn State Law's Entrepreneur Assistance Clinic at the Happy Valley Launchbox. In this role, Stephanie supervises law students in representing startups and early stage businesses across Pennsylvania. Prior to beginning in this role, Stephanie was an associate attorney at the law firm of McQuaid Blasco, where her practice focused on business law, estate planning, and estate administration. Stephanie received her undergraduate degrees in political science and philosophy from the Schreier Honors College at Penn State University, graduating magna cum laude. She received her law degree as well from Penn State and graduated there magna cum laude. So we're excited to have you, Stephanie, and I'm going to turn it over to you.
Thanks, Cindy. I'll go ahead and share my screen for today's presentation. Hopefully now everyone can see the slides. As Cindy said, today we'll be talking about operating agreements. Before we get into the nitty-gritty details of operating agreements, I'm going to give just a few quick overview of the Entrepreneur Assistance Clinic where I work and the services that we may be able to provide that could be helpful to you. So what exactly is the Entrepreneur Assistance Clinic? Well, we're a pro bono, so completely free legal clinic through Penn State Law that helps any small business across Pennsylvania that could benefit from our services. So we are staffed by 3 full-time licensed attorneys, including myself, and we oversee the work that's being done by about 22 law students a semester. And we also have law students over the summer, so we're able to keep open year-round. We're constantly growing, so we love to accept new businesses. Last year, we had over 1,300 clients that we were able to help. We don't require a Penn State affiliation. Really, the only requirement is that you live in Pennsylvania, and without our help, you wouldn't otherwise be able to afford a business attorney. So we work with a wide variety of businesses, everything from community members, students, entrepreneurs doing high-tech things to other small businesses like hair salons and restaurants. So pretty much you name it, we've worked with it at this point. If it sounds like we can help, here's a quick overview of our process. We have an intake form online. We ask you to submit. After you submit that, we assign new clients out when we meet weekly with our students. The student will reach out to you, ask some basic questions just to learn more about what you're looking for and how we can help. And then we'll get an engagement letter signed, which just formalizes the legal representation. So things that we commonly help with: choice of entity, of course, determining which entity is best for you, helping you form that entity, and then contract drafting, whether those are your organizational documents like operating agreements that we'll be talking about today, or just other contracts that you need to run your business, from a lease to independent contractor agreement, liability waiver. Really, you name it, we can probably help you draft it or review it. So that's an overview of the Entrepreneur Clinic. So now we'll jump into operating agreements. A quick slide first on LLCs, because we all know that operating agreements go with LLCs, like Cindy said. So just a reminder that LLC, or a limited liability company, is formed by first filing a certificate of organization with the state. The main benefit of doing this is really the liability protection that you get for the owners, also known as members of the LLC. It's a commonly heard thing in the clinic that clients come to us and say, is that liability protection as good as the liability protection you get with a corporation? The answer is yes, it's the same liability protection no matter what. And LLCs are usually preferable for small businesses due to their flexibility that you can either have in tax, management, or ownership that we'll be talking about today, and how you can change that in the operating agreement. So how you actually form an LLC: first, you need an EIN. then you file the certificate of organization that I mentioned. And then that third step that although it's not actually required is almost always, actually always, I'll say, recommended is to draft an operating agreement to have all of your members sign for the company. So what exactly is an operating agreement? It's really just the internal document that provides the roles for the LLC. It'll talk about management, governance, the allocations of profits and losses, the relationships among members, the rights and duties of those members, managers, if you have them, the activities the company is going to engage in, and how the company is going to procedurally approve transactions. All of that is set forth in the operating agreement. Without one, you're stuck with either the default roles under the statute, or worse yet, an ambiguous situation where it's not exactly clear what the rights and duties are or how you can go forward with approving a transaction. You can think of an operating agreement kind of as the equivalent of bylaws plus a shareholders agreement in corporations, if you're familiar with those. So it's really just those internal documents. And you can add other things in it as well that document the private agreement among the members if you have something unique to your business that the owners want to agree to. In the state of Pennsylvania, operating agreements can actually be verbal or implied. We don't ever usually recommend that just because it's, again, the ambiguity comes into play of if there's ever a dispute, you end up in a he said, she said type situation of what exactly those terms were if you didn't write them down. So instead, you should have a written operating agreement. And again, it's an internal document. Sometimes people say like, oh, I don't want to go through the hassle of filing it with the state, or are there extra fees involved? And the answer is no. It's completely internal. It's not filed with the state anywhere. The good news about that is there's no additional fee. And if you ever want to amend it, you don't have to update the state in any way. You just amend your internal document, update your records, and move on. So the question that we hear all the time of, do I actually need this document? As I just said, it's not required by law in Pennsylvania in order for you to have a valid LLC, but it is always best. And it's best to have one at the beginning when you actually form the LLC. So we usually recommend that the operating agreement is actually dated the same date that your LLC is formed. So that way it's in effect from the very beginning. For single member LLCs, so only one owner, sometimes the owner will say, this seems a little absurd. There's no one else involved here. Why do I need this document? The answer there is someone's probably going to ask you for it at some point along the way. So at the very beginning of your business, when you go to open a business bank account, oftentimes the bank will require a signed operating agreement along with an EIN and a certificate of organization in order to open that account. So that's the first hurdle. Even if you make it past that one and the bank doesn't require it, other third parties might at some point too. These would be parties like a lender, a title company, basically any third party that you're engaging in a transaction with that is going to want to know who has the authority to sign on behalf of your company. They know what an operating agreement is, and they want to see that document to know that you actually are the owner of the company, and therefore you have the authority to sign on its behalf. Same thing goes with multi-member LLCs. The same parties might ask you for it. And also now you have the added complication of more people. So it's important to have your agreements written down to really help avoid any disputes that may come up in the future. A lot of times people think, hey, we all get along great right now. And that's wonderful. But it is one of those things that you get along great in the beginning. It doesn't mean it's always going to stay that way. So by entering into an operating agreement while everyone's on good terms, that can help smooth over situations later as they come up. So for those reasons, we think it's really always recommended that you have an operating agreement, no matter the size of your business. So what's actually recommended to go in your operating agreement? We have some of the items that are listed up above, and the next few slides will go through each of these items in a little more detail. but just as a preview, there's organizational matters that you'll want to take care of. So just kind of some boilerplate language to go in each one. In addition, you'll want to address the allocations and distributions of your profits and losses and how that's going to be applied in your company. Management is one of the biggest ones. So is your company going to be member managed? Again, members are the owners. So just managed by, you know, majority vote of the owners, or were you going to designate a specific manager to be involved and to really have the authority on behalf of the company? The place to set that is also in the operating agreement. Same things with capital contributions and capital accounts. How are you going to keep track of the amount of money that you've put in? Fiduciary duties, if you want to change those at all. There are some limits on that we'll discuss a little bit later. Transferability is a huge one of how are you going to admit new members? Are existing members allowed to either sell or transfer or even bequest in their will when they die? What happens to their ownership interest? And then finally, dissolution. If the company decides that it's no longer, you know, worth running, what exactly is the procedure set forth in order to dissolve the company? So one of the very first things that would go in every single operating agreement are your organizational matters. And this is really basic common sense items such as, you know, the name of your company. And you should update this as time goes on. If you change the name of your company, like a lot of people do, the date that it was formed, what state you filed and formed your company in, what's your registered address? Same thing with updating it as you go along if you change it. A registered agent, if you have one, assuming that you don't have an address in the state where you're formed, that's where that would typically come up. And then the name, address, and ownership of each member, which again are just the legal owners of the LLC. So it's really just, you know, your housekeeping record type things to really have just the basics written down about your company in a place where everyone can agree what they are. And here's our records. The next item that's a pretty important one is the allocation of profits and losses for your company. So operating agreements will usually specify how any profits and losses are divided amongst the members for the company as the company brings in revenue and makes some income. So the typical way that you can do this, or that you would do it, is with the ownership interest, meaning if you're a 50% owner of the LLC, it would be normal for you to receive 50% of the profits and losses. And that's what most people want. So we recommend that that goes in the operating agreement. And this is one of those areas that I'll touch on at the end of the presentation, that if you don't actually set forth the allocation of profits and losses in your operating agreement, the default statute's going to apply, and it's not always going to be what you think it is. So as long as you have a specific item in mind for how you want your profits and losses allocated, it's really just beneficial to set it forth in writing. Same thing, how is your entity going to be taxed? Are you going to have the default pass-through taxation, meaning no separate tax at the entity level, rather than any tax liability passes right on through to the members' individual tax returns that they'll report in proportion to their ownership interest? Or are you going to make an election to be taxed as a different type of entity? LLCs can elect to be taxed as C Corps or S Corps. So the place to say that you're going to do that as a company and who has the authority to make that election would be in the operating agreement. And then of course, you'd also have to, you know, fill out the IRS form to make the election, but you should at least have in writing in the operating agreement who has the authority to make that election on behalf of the company. So those are some of the most important profit and loss allocation terms that would go in. Same thing with distributions. Most people that have a company, they want to receive some money at some point in time from their company. So it's important to address how and when the company funds are going to be distributed to members. So timing of the distributions, are they just going to be whenever the members vote or the manager authorizes a distribution? Are you going to have mandatory distributions, or will they be purely discretionary? Is there a certain amount that has to be distributed? These are all items that you should be thinking about and that would go in your OA. So a common provision that you might want to have that wouldn't be the norm if under the statute, unless you put it in an operating agreement, would be that you want to require a minimal tax distribution in order to avoid what we call the phantom income problem. So this goes back to that pass-through tax liability. So if you have money coming into your LLC and say you're a 50% owner, you're going to owe 50% of the tax on whatever money came into the LLC on your personal tax return. And that's whether the LLC has actually made a distribution or not. Because it's that pass-through entity, you automatically have tax liability for income coming into the entity. So in order to avoid this problem where you have a tax bill at the end of the year, but you didn't actually receive any money, a lot of times people will put in this minimum tax distribution requirement, meaning that the LLC is required to make a distribution that at least covers the tax liability that you're going to have for receiving any money that was brought in. So that's a pretty common one that a lot of people want in there. And again, if you didn't have an operating agreement and didn't put it in there, that's not the default under law, and you would just end up with a tax bill and no money distributed to pay it. You can also distribute funds that are subject to several different restrictions. For instance, you could say no funds are going to be distributed this year if the LLC would not have any money left to satisfy business obligations. That's usually a given under the law, but sometimes people like to just put it in the operating agreement anyway. Management is one of the very biggest ones that you should address. And the reason for that is under Pennsylvania law, by default, your LLC is member managed, meaning that every owner in the company is going to participate in managing that company. And decisions are usually going to be made by a majority vote of everyone. So if that's not how you want your company to be managed, you need to change that in the operating agreement. So a lot of times people want to have a manager managed company, meaning that you appoint one or more managers to make the decisions. And this makes a lot of sense, especially if you have a lot of members. It just isn't practical to have all of the members involved in the management. It slows things down. So it might be better to just designate one person to make the decisions. So you don't make this election anywhere with the state. The only place you put it is in your operating agreement. Some specific items to keep in mind regarding these management provisions are you should specify whether the manager actually has to be a member in the company. Some people want the manager to be an owner in the company, so they have, you know that they're interested in the well-being of the company. They're an owner, they're involved. Other times people want the manager to be a third party that isn't necessarily a member in the company because they think that they can provide better management by not being quite so involved in the matters. For instance, if you had a business advisor or someone like that that was willing and you thought would make a good manager, that's where sometimes the manager might not have to be a member, and you would want to put that in the operating agreement. You also, of course, want to set forth the process for how you appoint a manager. So is it a majority vote, unanimous vote? Do managers just appoint each other? What's your process there? And how exactly do you remove them? So if you decide that you don't like the job that the manager is doing, what percentage of a vote or what's the process there for changing the manager and replacing them? Same thing with what's the procedure for actually making decisions? Do you need to have meetings? Can you have a unanimous consent in lieu of meetings because it's cumbersome to sit and have a meeting? What's the quorum that you need at meetings if you're going to have them? Do you need to give notice before these meetings exist? These are all items that do have default roles under the Pennsylvania statute, However, a lot of times the default rules are just a little clunky for what you want. And luckily, because LLCs are so flexible, you can change these items in your operating agreement as well. Same thing with if you appoint a manager and then decide that you don't want the manager to be in charge of quite everything. Maybe you want to limit the manager's authority in some aspects. So for instance, you appoint a manager, the manager is overall going to be in charge of decision-making. However, if you go to dissolve the company, or if the company maybe makes a purchase over $100,000 or some limit that you have in mind, then the manager can't unilaterally make that decision. Instead, you'd want the members to come in and have to vote on that as well, because it is such a big ticket type decision. That's a very common provision that people will put in manager managed operating agreements. And then required consent, like I just talked about, of what percentage or who needs to vote in order to approve transactions. Is it a majority? Is it a supermajority? Is it unanimous? What percentage do you want? And do you want that to vary depending on what the decisions are? Fiduciary duties come into play as well. So managers and members, if you're in a member managed company, will owe fiduciary duties of loyalty and care to the company itself. So what exactly does that mean? The duty of loyalty just means that you're going to avoid self-dealing transactions and competing with the company. So you're not going to engage in, some kind of business transaction that benefits you individually as a member. Instead, you're going to just act in the best interest of the company and not compete with its business. Duty of care is really basic. You are going to refrain from activities that could be considered grossly negligent, reckless, willful misconduct, or knowing violation of law. So as long as if you're a manager or a member and you're making decisions on behalf of the company, you're not going to make decisions that could be considered grossly negligent. Apparently regular negligence is okay. Just gross negligence is where they draw the line for violating the duty of care. So you can't actually eliminate these duties that are provided in the law in an operating agreement, but you can provide some carve-outs. So you could provide a procedure where you can authorize or approve a transaction that would otherwise violate the duty of care. For instance, if you have a member that has some type of self-interest, maybe they have a membership interest in another company that is somehow related, and the two companies might engage in a transaction together, you could provide a procedure where the other non-interested members would vote and ratify and say that this is okay, despite the self-interest that the one member has. And the place to do that, again, is in the operating agreement. And you can't, again, eliminate the duties completely, but you can provide just some alterations of scaling them back just a bit if you think that it's going to be a common issue with your company. Potential consequences of breaching fiduciary duties. These are pretty much set under law, but just to keep in mind when you're wondering if you want to alter fiduciary duties or not. So the normal consequence would be compensatory damages. So you're going, if you or another member breach a fiduciary duty, the non-breaching members could sue you for damages that incurred as a result of the breach. There's maybe some possibility of punitive damages if you acted with fraud or malice or some type of super knowing violation of an action, or some professional repercussions as well if you're a licensed individual. But in general, it's just going to be the fear of a lawsuit and damages that ensue. So let's talk about transferability. So your ability to transfer your membership interest, your equity interest that you own in the company to another individual. This is often one of the most difficult sections of an operating agreement to figure out together because it's one of the ones that can be varied the most. So it's often heavily negotiated as well, because there's so much variance in how you can write it. So we're going to go through each of the common provisions that may or may not be included in your operating agreement that are listed there on the slide, in each of the following slides. Now, it wouldn't necessarily be typical to have all of these provisions. Usually you just have a few that make sense to your situation and what you're thinking, but just keep that in mind as we talk about each of the provisions. So restrictions on transfer, that's one of the biggest ones. So meaning, do you want to restrict the ability of other owners to transfer their interest, their equity interest in the company to a third party? If you don't address this in the operating agreement, the default law is that members can freely transfer their economic rights in the interest. The law will split your membership interest into economic rights and governance rights, meaning, your rights to receive those profit and loss and distributions and the allocation. Those are your economic rights, and your governance rights are your rights to vote on a transaction. So the default law is you can freely transfer your economic rights to any individual without dealing with any other members in the company. If that doesn't sound like something that you want for your company, you may want to alter that. It's really common to say, especially in these small companies, that you need to either require the manager, if you have one, or member approval in order to make any transfer at all. And the reason for that is people don't want other individuals that they didn't start out with as a business owner coming in and owning the company. Sometimes there's some carve-outs where you'll say no transfers whatsoever unless the transfer is a permitted transferee. And that's talking about the permitted transfer section that you'll see there on the slide. So this is usually an exception to that general transfer restriction. And it's common that you would permit transfers to closely related family, such as your spouse, your children, grandchildren, anyone in the lineal descendants is the term that's usually used, or maybe other LLC members that are already existing. So the way that would look in your operating agreement would say no transfers whatsoever without manager approval, unless you're going to transfer it to your spouse, your child, or another existing member of the LLC. That's usually the common way that that's done. But again, that doesn't have to be the way that you do it, because the thing to keep in mind with drafting an operating agreement is really you can tailor it as much as you want. Some other common transferability type provisions that you might include would be a right of first refusal or a right of first offer. So they sound a little similar. They do have a slight difference. So a right of first refusal requires a member that receives a bona fide offer from a third party to sell its membership interest to first offer that interest to the other members or the company first on the same terms of the offer that they received. The right of first offer, the difference there is they're not receiving an offer from a third party. Rather, the member just knows that they want to sell their interest. So here you're required to offer your membership interest to the other members or LLC before offering to sell it to another third party that's not involved in the LLC. Same thing, typically the offer is going to have to be on the same terms that you're going to offer it out. And usually in both of these cases, you'll want to do some specific drafting that sets forth the time periods of if the other members don't execute their right of first refusal or right of first offer, maybe they have 30 days or 45 days or whatever the time period is, that then they have that much time to execute their rights. If they don't, then that individual that's trying to sell their interest can sell it to the third party for maybe another period of 15 days or 30 days, whatever they want. So there's a lot of careful drafting that goes into drafting a right of first refusal and right of first offer, because you do want to set out the exact time period and procedure for providing these offers to the other members. Reason for that being is oftentimes when these come into play, it's usually, not usually, but it could be a contested situation where maybe the individual is trying to sell or wants out or wants some other reason. So really the more detail you have in these provisions, the better. because again, it's that ambiguity that's never good if people are trying to make a decision at a time when they're not necessarily getting along. The final transferability provisions that you might have are drag-along rights or tag-along rights. So drag-along rights are really to protect the majority owner of an LLC. They require that minority members join in the sale of the company to a third party. So maybe the majority owner wants to sell to this third company that's offering to buy the LLC, but the minority member doesn't want to, and they want to hold out and block the sale. So if you want to avoid that situation, you could include these drag-along rights in your operating agreement that would prohibit the minority member from blocking a sale to a third party, because the majority member could say, hey, look, we're selling, so you're going to have to come along, but on the same terms that I'm selling my interest. Tag-along rights is really just the flip side of a drag-along right. So this one protects the minority members of an LLC. It's the exact opposite. So it provides that if the majority member is going to sell their interest in the company, the minority member has to be allowed to participate and sell their interest on a pro rata basis on the same terms. So it's just to protect that minority interest of maybe an individual is only interested in buying the controlling majority interest of a company, but that minority member doesn't want left behind and to have to work with this new owner that they don't even know. So this would prevent that situation and allow them to also sell their interest in the sale. And then finally, buy-sell provisions, which govern how the membership interests are treated when a member leaves, are a huge area that you can address in the operating agreement. So these are provisions that are going to either require or permit members to buy or sell an interest. They often come into play in specific situations, such as when a member dies, or if they become disabled, if they're divorced, if they file for bankruptcy. Maybe there's a deadlock disagreement between members that can't be resolved for a certain period of time, or maybe a member who's an employee of the company is terminated by the company, so you want to buy their interest back. These are all situations where another third party could come into play as being an owner in the company. If you didn't, have some kind of prohibition on having it happen, and also have a procedure set forth for if a situation like this comes up, how exactly are you going to handle it? So are the other members of the company permitted to buy the interest of a member who's maybe passed away? If so, what's the price? Or maybe are they required to buy interest back from a member who's passed away? Again, you need a way to value it. So the most difficult part of putting a buy-sell provision into your operating agreement would be providing a clear procedure for what exactly the value of that interest is when it's going to be purchased. So there's a few different ways to do this. A lot of times people will just say, well, easy, fair market value at the time of death or whenever it happens. That's fine, but the difficulty with that is, how do you determine fair market value? If you're going to say appraisal, oftentimes appraisals are pretty expensive and you might not want to pay for that when this situation comes up. So an easy alternative would be to have a fixed price or a formula in order to determine the value of the interest. So a lot of times people will say, let's have an annual meeting, maybe on the first Monday of the year, and we'll set a price for if something happens, if someone dies, if someone gets divorced or whatever, one of these triggering events in the next year, here's the price that membership interest will be purchased back at. And it sounds like a broken record, but it's a good idea because it's easier to set that price when everyone's on the same page and no one's having any hard feelings and the situation hasn't come up yet. So that way, when a situation does come up, the price is already set in stone. You don't have to negotiate it. You don't have to fight over what it is. It just is what it is, and it's set forth in the operating agreement. So finally, one of the things that you might want to throw in is the procedure for dissolving your business. So dissolution, just to set it forth from winding up and terminating the business, is the term that's used that just begins the process by which the business legally ends. And then winding up is actually the process of closing the business. So, liquidating your assets, disposing of property, paying any liabilities that you have outstanding, all of that before you can actually terminate business operations and close up shop. So it's common that an operating agreement will have provisions of, if you want to dissolve, what exactly is the process? So maybe you have a specific term. Some businesses only exist for a specific purpose. So after that purpose has ended, there's no reason for a business anymore. So maybe that's your term, that the business is going to automatically dissolve upon, 5-10 years, or whatever your time period is, or once you've achieved whatever your business purpose is. It's a little uncommon, but you could do it. The more common way to do it would say a written consent of either all or some percentage of the members. If you're going to include this, big thing to keep in mind is, what is that percentage? So do you want unanimous consent? Could be problematic if maybe you have one person that's a holdout and then prevents you from dissolving the company. But maybe majority seems too low in your situation. So you just have to think what works best for you. Maybe a super majority is the answer there of what percentage of consent is needed to dissolve the business. Of course, judicial dissolution, maybe if you sell all of the assets of a company, it's common that you don't have to pick just one. So in your operating agreement, you can say company will be dissolved upon any one of the following actions. And it could be all of these items or any combination that you want to include. And then same thing with winding up. What exactly is the process for liquidating and disposing of property? Who has the authority to do that? Is it the manager? Is it a specific member? Do you want to designate a person or a title that's going to really take care of cleaning up all those final actions? So then the obvious question here is, what about if I forget to put something in my operating agreement, or if my operating agreement just doesn't cover it? Because at the end of the day, it's probably impossible to put absolutely everything in your operating agreement for every scenario that could ever come up. There's always going to be something weird out there. So the answer is the Pennsylvania statute would govern it as long as it addresses it. If the statute doesn't address it, then you're stuck with probably looking to case law or other court opinions. And that's when you have that ambiguous, not great situation. In most cases, though, it's going to be the statute that governs. While this is helpful, it could also not be great depending on your situation. I have some examples here on the board of areas where probably what most people want do not line up with what the default says under the statute. And this shows the importance of an operating agreement. For example, if the operating agreement is silent on the standard for member approval, so how many members need to approve an action and how they're going to be approved, the statute actually provides that matters before the members will be decided by reference to the number of members. So what this is saying is it's called head count voting. So if you have 5 members, so 5 owners of the company, and you need to make a decision, it's each person gets 1 vote. So you will need 3 people out of the 5 to vote to have a majority decision. That's the default under the law. And that would be the case even if, say, of those 5 members, one of the members maybe owns 60% of the company, and then the other 4 each only have 10%. So you would think under common sense that that 60% member is the majority interest owner of the company. So automatically they're going to have the majority vote. That's not true under the Pennsylvania statute. Each person still only gets 1 vote, regardless of how much percentage of the equity of the company they own. So this is really one of those items where that's not what most people want. Most people want the members to vote in accordance with their equity percentages that they own. So that's why it's important to put in the operating agreement that that's how you want voting to be handled. Same thing with distributions. So the statute provides that distributions by an LLC shall be in equal proportions among the members. So what that's saying is, again, regardless of if you own 60% or if you own 10%, any distribution that's made is just going to be split among, the 5 of you or however many people there are equally. And it's not going to take into account what percentage of the company you own. Again, not what most people actually want. So it's important to put that in an operating agreement and vary it. If you know that the statute is not the typical item that you want to have. So that's pretty much it on operating agreements. Now I'll take some questions, and also I have up a slide here of my contact information. My email's there on the slide, and also if the Entrepreneur Assistance Clinic, if it sounds like we can help you with anything, drafting an operating agreement, for instance, or even anything else, you can find us by searching Happy Valley Launchbox. Our intake form is there. You can send me an email. I'll email it to you, really, however is most convenient to you.
Stephanie, thank you so much. And we appreciate you sharing your email address. That's helpful as well. We do have a few questions posted in Q&A. And so if all of you listening, if you have a question, we encourage you to use Q&A. So we're going to just start with the first one. Is there do you have, or does the SBDC have a template operating agreement for a single or multi-member LLC that can be shared as a resource with today's participants? And I know I have a template. I didn't know if you did.
We do have templates, but we don't typically share those without having a conversation first. Okay. Just because, the legality of providing legal advice without actually providing it. So instead, our services are free. So just have a conversation when we'll tailor that template to be exactly what you need it to be.
Yeah, that makes sense. And ours is a very there's so many blanks on it. It's almost
exactly.
It's pretty general.
It's pretty hard to provide a template that actually covers everything. So
yeah. So the next question is, do operating agreements usually have language regarding professional liability insurance, as well as directors and officer coverage? Any thoughts on coverage amounts for each type?
Well, I would say they don't usually have that language. There's nothing preventing you from putting that in. If you wanted to have some type of insurance require a minimum policy amount. Usually instead, the language that operating agreements will say that as long as someone is not, violating their duty of care and engaging in some kind of reckless activity, if they do get sued just in their action of being a member or manager or whatever, the company will actually indemnify and reimburse them for any expenses. So it's kind of similar, not quite insurance, but that's what it typically has. However, if you wanted an insurance requirement, you could have that. I don't have specific thoughts on coverage amounts. That's really, I don't sell insurance. So that'd be more of a conversation to have with an insurer.
Okay, thank you. And then next question, is it reasonable in operating agreements to have non-compete provisions, perhaps with limited time periods such as 2 years for a multi-member LLC to ensure a member does not compete with the LLC for the same clients? And then the question continues, or should the members have employment agreements with the non-compete provisions?
Yeah, I would not recommend that a non-compete go into an operating agreement. If you were going to have a non-compete for specific employees, then the appropriate place, you're right, would be an employment agreement. Reason for that being non-competes are pretty unfavored by the courts. There's in fact legislation pending to just prohibit non-competes and not allow them to happen anymore. So in order to make sure that your non-compete is going to stand up, the best chance you have is to make it as narrowly tailored as possible. So to that specific employee for, the smallest geographic radius for the smallest term of years or however you're going to do it. And you would want it to be employee specific. If you tried to put it in an operating agreement, have it apply to all members equally, it probably would never stand up.
Okay, well, as a follow-up there, if someone, so you're saying an employment agreement should have the non-compete provision in it. And
yes.
if they're not, if they're not very strong or not being held up in the court system, what do businesses have left to do to try
Yes.
and protect employees taking clients with them?
We usually recommend a non-solicitation versus a non-compete. Non-solicitation, so you can't solicit customers or other employees or anything from the company. Those are a lot more favored and more likely to stand up than just saying that this individual can't, work in this specific industry anymore that competes with the business. So you can still, again, if a non-compete's appropriate, you could put it in an employment agreement, but you just want to be careful with how narrowly tailored it is. And we would recommend a non-solicitation to try to, or a non-disclosure, combination of both, to keep employees from taking information or other customers.
Okay, great. The next question is, what is the state statute law if a member dies and there is no buy-sell agreement in place?
So it's gonna, I'm gonna give a attorney type answer of it depends, but the typical way that it would work would be if the member dies, no buy-sell agreement, nothing specific in an operating agreement, whoever is going to receive the deceased member's interest, either whether they have a will, so under the will, or under the law, if they don't have a will, would receive the economic rights. So their rights to receive distributions if there aren't any, but they would not have any rights to participate in the management of the company. So that's how it would typically work.
Okay. And so Jessica, yeah, we will be distributing the recording. So that will be coming. When you are the only owner, none of this applies. Is there anything specific needed on the agreement for one owner? And you did talk a little bit about that.
Yes. So the answer there would be, it's not that none of it applies. It's that life is a lot easier for you. Your operating agreement is probably going to be like 2 to 3 pages versus like 10 if you had multi-members and had to consider all of these buy-sell provisions. We still would recommend an operating agreement just because someone might ask you for one, whether it's a bank, a landlord, a lender, anyone that you might interact with as your business. And really all they're looking for is to see your name, that you're the member and the sole owner of the company. So usually your agreement is like, again, 2 pages with boilerplate. It's pretty easy. And it does say that if you add any additional members, then you need a new operating agreement because things become complicated.
Great. So the question is, I would like to go back to your initial pages of filing for an LLC. You stated the order was an EIN, the certificate of organization, and then drafting of the operating agreement. What if your business is a self-publishing company? Is an operating agreement necessary?
Yeah, same thing. It really doesn't. I'm assuming you mean self-publishing, that you're in the business of publishing, I'm guessing, and not, because I'm not sure what else that would be referring to. But I would still say it's necessary. I mean, you need a bank account because you can't commingle your funds, then you're going to lose the liability protection that your company provides. So at bare minimum, you need a business bank account. Usually banks are not going to open an account without an operating agreement. Maybe you found a bank that will, in which case, good for you. But it's just better and it's neater and cleaner to have one.
Okay. And I think the last question you already answered. It says from same person, if the operating agreement is not necessary, can the self-publisher get approved? I'm not quite sure what approval they're looking for.
Yeah, me neither.
Okay.
Yeah.
Maybe they can provide some additional information there. For a single member LLC, should it include a provision on the dissolution of assets/funds?
It'll usually have one that pretty much tracks the statute. It'll just say, that member has the authority to distribute assets upon distribution after they've paid all liabilities. So it's pretty basic. It'll just track the statute basically, but it's not required necessarily because you're right. You're one person. Of course, you'll be the person distributing the assets.
Okay. the approval question, it says, would the state approve an LLC?
Oh,
And
okay. Oh, sorry, go ahead, Cindy.
No, go ahead. That's the question. Would the state approve the LLC?
Yeah, so I guess you're meaning with the state approve it if you don't have an operating agreement? The answer is yes. Operating agreements aren't required under Pennsylvania law. All you need is your certificate of organization to be filed. But again, not required, always recommended.
Okay. So any other questions before we finish up? I guess I'll just quickly start. If there are some other questions, we'll jump back. Okay. Okay, so the individual is saying, can the operating agreement be added at a later time? I'm assuming, can the operating agreement be created at any point in time?
Yeah, and the answer to that is absolutely. We recommend them at the beginning, but better late than never. So you can always add one on, add it, create it, whatever, execute the document. You can also change it at any point in time too. So it's not like, these aren't necessarily high stakes decisions that you have to pick a certain structure, pick certain provisions and live with them forever. Usually the operating agreement will actually set forth the procedure for amending it. So maybe it'll say majority vote of all members. And then it's as easy as that. You just change it and do a new one.
Great. So we're going to be sending out an evaluation for today's webinar. So we just ask that you look for our email. We are looking for feedback on today's content, as well as other information in regards to the training that you're looking for. You know, I'm with the Pennsylvania SBDC. We're always looking to respond to your needs. And so please look for the evaluation and provide feedback. Stephanie, thank you. We always love having our friends at the Entrepreneur Assistance Clinic join us. I appreciate your time today. I appreciate what you do. Certainly, we couldn't be as productive with the work that we do without your help. So I truly thank you and your colleagues at the Entrepreneurs Assistance Clinic.
Thank you.
And
thank you for having us. We love to help. So
sure. All right. Well, thank you. As soon as the recording is processed and the slide deck is prepared, I'll be sending it out possibly before the end of the day, if not first thing tomorrow. Thanks everybody for being with us, and we look forward to having you join us at future events. Thank you.